and share it with anyone you want to as well. So yeah, that's about all we need is logistics. And I'll say welcome everybody in the audience. Thanks for being here. We haven't done a Market Watch webinar in, it seems like, about 9 months. And so a lot of people are wondering, like, hey, are things recovering? Or are you going back into real estate, Sarah? You haven't done any real estate acquisitions in a while. Is it a good idea? Is it not a good idea? What things are affecting it? What markets are staying strong? So we're like, all right. So let's put together a webinar. Let's talk about it. So we have 3 operators here today. In our portfolio, we have over 40 properties collectively among us, and I don't even know how many different markets represented in our portfolios. But an area that we're all seeing as really strong is Dallas. And so mostly we're going to talk about Dallas today. I'm going to bring up some market data, show you some resources on how you can pull it, and then we're going to talk to Ashland Green, a really strong operator in Dallas, about how they're doing it, what they're seeing. And then we'll touch on the next investment opportunity that we're participating in, that we're co-GPing on, that we will share with you guys. So with that, I don't need an introduction to this group. Amy, do you want to introduce yourself? And then Shakti, I'll pass it to you.
Of course. Thank you so much, Sarah. Yeah, really excited to see everyone here. As you mentioned, we're in an exciting time in real estate. I know not everyone characterizes it as that, but we're really excited at the opportunities. Truly, we're just being real here. But I'm Amy Silvis with Silvis Capital. I'm the founder and CEO of the organization, and we find amazing properties for you to invest alongside us to produce great cash flow, great returns. And yeah, we're really excited to have you all here and host Shakti here with Ashland Green.
And I'll introduce Shakti a little bit more because a lot of people use Amy, because we partnered on, quite a few properties together.
Yes.
So Ashland Green, so last year, I personally invested $400,000 with Ashland Green across, well, it's 3 properties. It's two different investments, but 3 properties. So I'm always out there looking at different operators, looking at additional people to partner with. So I invested with them as an LP, and I was really impressed with their professionalism, with their offering. I'm always looking for, like, not the next shiny thing, but this part of my portfolio, multifamily, is like my safety section of my portfolio. Like 60% of my portfolio is calm money that's in multifamily with strong operators. I do invest with new operators, but for wealth preservation and growth for my future, for my family, my legacy, I invest 60% in multifamily with strong operators. And so Ashland Green, we'll talk about their track record, but they're solid. So I invested with them. The 3 investments I have with them are cash flowing, and I am really happy with how they're performing. And so we reached out and said, hey, let's do some more together. Let's partner up on some stuff. So that's what we're doing. So Shakti's here. And so this is, the beginning when I teach due diligence. I say due diligence on the team, due diligence on a market, and then due diligence on the investment when you're looking to be a passive investor. So this webinar is going to be the first 2 steps where you're doing due diligence on this team. Collectively, we're at GP on the next project coming up. And we'll also talk about the market. So Shakti, why don't you introduce yourself? And I think that Ashland Green's story is interesting about how you got started and how you're so focused in the area you are. So I'll let you take it from here.
Yeah, sure. Well, thanks for having me here, Sarah and Amy. Super excited to be here with your investors. Certainly quite a few people here showed up. So thank you for the investors, for joining this webinar. Yeah, like Sarah mentioned, we sort of partnered up with Sarah and Amy kind of in the back half of last year. So it was nice to get you guys personally invested before sort of introducing me and the Ashland Green team to your broader investor base. But just a little bit about Ashland Green. So, I started, the company. I'm the founder and the CEO. We're a vertically integrated owner-operator based locally here in Uptown Dallas. We own about 17 properties, a little over 5,000 units, and we manage all of them through property management, our own asset management. We also do our own construction management. So we launched our business buying multifamily real estate here in DFW in 2017. I was living in New York at the time, where I was a real estate broker. Before that, my background is in finance. I worked at Lehman Brothers and I worked at a private equity fund up until the summer of 2008. Slowly started sort of buying properties on my own in 2010. And then in 2017, sort of wanted to see what was available that was a little bit larger. And so I started looking at 20 unit, 30 unit properties in New York. And then my parents live in California. That's where I grew up. Started looking in California as well, Southern California, and noticed that everything over 4 units, 5 units was rent stabilized or rent controlled with no cash flow. So then I started kind of looking in the Sun Belt in the summer of 2017. My first stop was Atlanta, spent about a week there, made a few offers, nothing happened, came to Dallas, and miraculously one of my offers was accepted, and started putting together some capital, small raise of about $2-3 million. We closed on that property, closed a few more. And then in the summer of 2019, I was able to convince my wife to move here to DFW. So we packed up with our 2 kids, 8-year-old and a 4-year-old now, but that was about 4 years ago. Packed up, moved to DFW. And then 7 months later, COVID hit. So that was kind of an interesting moment in time to be living here. And we were just kind of figuring things out during the summer of 2020 with our property management. We had about 6 properties. We were third-party managing, and after about 4 months of third-party managing during COVID, we saw our delinquencies going up, our occupancies falling up, our deferred maintenance at our properties was skyrocketing, and our collections were down. So we were managing our cash flow very tightly, and we decided, it doesn't make sense to continue with third-party management. Everyone that I spoke to told me it was a bad idea. I read a book called The ABCs of Property Management by Ken McElroy, super smart guy, someone I really look up to. And basically it's 200 pages of horror stories of property management. And I got about halfway through it in the summer of 2020. I said, I don't think I can do this. And then performance continued to deteriorate at our properties, and picked the book back up again. I finished it, started putting kind of like some ideas on paper. And by November of 2020, we took over our first property. And then we took over property number 2 and property number 3 in December of 2020. And then January and February, we took over the last 3. So we took all 6 of the properties that we owned, that we were third-party managing, and we took them into our new property management company, which was called AG Living. And about 2 weeks after we took over our last property, the Texas freeze hit, and 150 units in our 1,200 unit portfolio went down. So we started a construction management company out of the frustration related to the Texas freeze, because we weren't able to get contractors to come and do the work. I was out there actually one night sweeping water out of an apartment here in North Richland Hills at midnight with my lead maintenance and my regional. So kind of been through, all kinds of odd.
I think that's why in the book it said, don't do it.
Yeah. And he was right about it. But if I kind of fast forward to sort of where we came from, from COVID till now, I would say that, given all of the different, dynamics that are at play with the Fed and, bridge loans and interest rate caps, and, everything is about managing cash. And, having the vertical integration gives us a huge advantage kind of going into this, light to moderate recession, which I feel like we're already in. But as it sort of progresses through the back half of this year, we're pretty laser focused on our cash, and making all the right moves in terms of staffing to ensure that our properties continue to perform. We've never had a capital call. We've never had any mortgage forbearance. During COVID, we haven't had any on any of the assets that we currently own, and nor are we forecasting it. So I would say that kind of being local to the market, being vertically integrated, and sort of having experienced what we did, kind of coming out, I got into real estate in the summer of 2008 as a broker. So kind of learned that business from the kind of the worst time. I got into property management during the summer of 2020 during COVID, and then I got hit with the freeze and started construction management. And we exited 6 deals last year during all the interest rate hikes. And so I feel like, Ashland Green was sort of born in distress, and we're sort of built for this sort of environment. And the fact that we're local and kind of have the background that we have here, not just myself, but a lot of the leadership team here, it's kind of setting us up to be successful in this moment in time, which I agree with you, Amy, is actually a very exciting opportunity, because we haven't seen pricing like this since 2018, maybe, when I first started buying real estate here in DFW.
And I think it's interesting what you're saying about like being vertically integrated and managing cash flow. And that's going to be really one of the predictors of, we see evidence that was the reason that, people who have been successful over the last couple of years, it's been because they can manage cash flow and going forward as well. And then your background at Lehman Brothers and, your education, I think that probably also set you up as being uniquely successful at this point in time as well. Operators who may have had a totally different background might not have that strong base knowledge you have for cash management.
Yeah, absolutely. And, at Ashland Green, we don't just buy the real estate, but we kind of operate every piece of the life cycle, from the purchasing of it to the asset management, construction management, property management. So every single part of it is critical in terms of delivering the returns for our investors. So, I mean, we're pretty obsessive about the operations here. And so in times like this, it's already May and we haven't closed on our first deal in 2023. Last year, we had 12 acquisitions and 6 dispositions, so 18 transactions in total. And so that means we were basically doing one transaction every 2 weeks or something, give or take. But it was a very busy year. But what we've done really in the last 5 or 6 months, since we've kind of been out of the acquisition space for the last 5 months, we've been really focusing on staffing. And that's a huge passion of mine. I'm a big Jack Welch kind of fan, and I read his autobiography, and he says after the CEO, the kind of head of talent acquisition, head of human resources is your most important function at the company. So we just actually brought in kind of a VP of people and culture, and she has a talent acquisition background versus other types of backgrounds that you could have in a head of people role, like conflict resolution or social work. So really kind of focused on the people aspect of it, building a culture, and just kind of building a sustainable platform so we can scale to 30,000 units.
Yeah, it's 100% what's needed. And that's the hardest part that I found in building Sugo Capital as well, is like finding all those perfect fits. Like not only the good of the job, cultural fit, all that kind of stuff. So congrats to you guys on that. I'm going to switch over and share my screen. We have a couple hundred people on now. So audience, you're in good company. We're going to switch over and start really digging into where our portfolios in the markets and some market data you can be looking at today to know where to be investing. Oh, look at that. That's not what I want to look at. Okay, so I'm going to start with Amy. So Silvis Capital, on their website, you can see their portfolio. Amy, you're kind of, you have stuff in Georgia, Alabama, Texas, some more Georgia, Indiana, Texas. So you're kind of all over. Are you seeing some markets that are stronger than others right now, and some that it's like, hey, it's really hard to make it work?
As you know, and anyone that knows me, I am a real market research, obsessive person. And to your point, Sarah, before we ever look at who we partner with, or while we look at who we partner with, before we ever look at a deal, we analyze that market. So I without being too, braggy, I think our properties have actually done exceptionally well, and aren't seeing some of the difficulties others are facing because we have chosen these markets so well. But one of the themes all of us know as real estate investors is investing in a place with a broad economic base, right? An economy where there isn't just a one-trick pony. So many of the Huntsville, Alabamas, where we've been, even the Evansville, Indianas, where maybe some people haven't even heard of that area, but there is a broad economic base for our residents to have employment, where there's net migration and job growth. So there really is a continuous theme there, and why those properties are doing so well, and why I'm so excited about Dallas, because talk about diverse economic base and net migration. There's so many great things that excite me.
Yeah, thanks for that. And I'll show you guys our portfolio. So this is where we currently have all of our properties, or the green arrows. Those that are yellow are ones that we already sold. So you can see it's pretty concentrated in Texas, and there's a reason for that. And we're going to look at some of the data. But even in Dallas, you could see we sold one, but we did have 6 total in Dallas. Dallas is huge. So there's submarkets to Dallas. So even some submarkets are performing stronger than others. And we're going to really let Shakti dig on this because he's the Dallas superhero in the house. But most of our properties in Dallas, they are strong, but some are still cash flowing and some aren't cash flowing anymore because they're in a submarket that is not as strong as some of the other submarkets. So, when you're looking at market data, there's the US and it has some numbers, and then you look at the state, and then you look at the city, and then you look at the submarket, and it's all relative, right? So when we're talking about, hey, in Phoenix, Arizona, what's the job growth rate? Well, it's 6 times what's going on in the rest of the United States. That's an important data point. But then also looking at how does that compare to Dallas? These are all things you're going to want to be looking at. I'm going to pop over now to the Ashland Green portfolio. And this is really cool, guys. So this is not on a map, but it's all in Dallas. And I'm just going to make it bigger.
There might be a map later on, but it sort of shows the other properties we're buying relative to our other.
Oh, okay. Like in the submarkets.
But yeah, this is, I think this covers all of them.
And I want to bring your attention, you guys, to the 6 that are at the bottom. Those are the ones that are sold. So this is their entire track record. So they have 17 that they currently own. And this is one of the reasons that I invested with them. So 17 that they currently own, and 15 of them are currently cash flowing today, given everything that's going on. Like some of our other properties, we pause cash flow for some reason or another. 15 out of 17 of theirs are currently cash flowing, and the 2 that are not cash flowing, it's just because they haven't gotten there in their business plan. So it's by design that they're not cash flowing yet. So I think that's really strong. And then from those that they exited, you can see the actual returns there. That's their actual annualized return. Those are all really strong, all of them at 19% annualized or above. So it's really, really strong track record. I'd love to hear, Shakti, you mentioned it a bit, but why? I mean, you're all in on Dallas. Amy and I are sprinkled all around. I like to diversify. We like looking at different markets. Why did you and Ashland Green decide to be so concentrated in Dallas?
Well, I think the fact that we're boots on the ground, we're local, is a huge benefit for us, because we can get out to the properties very, very quickly. And so, again, I did this remotely when I lived in New York for 2 years. Mm-hmm. And the reason I moved here, because I felt like I needed to be closer to the asset. And sometimes you got to roll up your sleeves and kind of get your hands dirty. And, we're in the value add space. It's not smooth sailing. It's not like you're buying a 2020. I mean, we have some newer properties, which you guys have invested in, those senior living deals. And those are very easy to run, very low expense ratio, completely different demographic of resident and employee. But when you start going into the older properties, to get those types of returns that Sarah, you showed on your slides, and that, we showed on the Ashland slides, they need to be managed very, very tightly. And, real estate's one of those things where it's not, information isn't as symmetric as it is in like the stock market, for example, to where you can just sort of get onto your computer and, look at some charts and graphs, and everyone pretty much has the same information. There's a lot of asymmetries of information, and I don't think you can take advantage of that the further and further away you get from the asset. Even just dealing with the brokers, I think, Texas is a very sort of Texas first kind of place. They kind of think that they do everything differently, and it's very, very Texas pride. I don't necessarily know if the other Sunbelt markets you guys work in have that same type of sort of, the pride of the local area. It's over the top here in DFW. And so I noticed that I was getting these not the greatest deals when I was in New York. And as soon as I moved here, I started getting, better looks at deals. I could go out, tour them very quickly, or secret shop them because we only buy off market deals. underwrite them, and then within 24 hours, I could get an offer to a broker and feel very confident about it. So I think the deal flow, the quality of the deal flow improved. I think our asset management improved. And of course, there's no way we could do property management and construction management without being local. So I think for us, the natural sort of evolution would be to look at some other markets outside of DFW in the next maybe 2 to 3 years, such as Austin, San Antonio, and that sort of 35 corridor. But, you know, there's 850,000 apartments here. We only own 5,000 of them. So not even 1%. So there's plenty of opportunity within this market. And we just know it really well. And sometimes on the acquisition side, speed is critical. And, you know, having a name brand is critical. And, you know, they know, like, if you want to, you know, if a seller needs to sell an 80s deal relatively quickly, it's a good location, and you need a buyer that's going to perform, that's not going to retrade, that's going to close, like Ashland's always on that short list of 3 or 4 buyers. And so, you know, that's a benefit for our investors, because they know that they're not getting something that, you know, 10 groups already passed on, or that's a marketed. We don't generally go through a marketed process. A lot of DFW is transacted off market. You know, sellers don't like to disrupt their staff. They don't want other people, you know, knowing about their financials. And so, you know, we'll sign an NDA and we'll, you know, kind of quietly get up and down on an asset. Like in Fund 6, you know, those are both off market deals as well, where there was some seller distress. And, you know, they have a lot of investors. Yeah, they have a lot of investors in the marketplace, and they don't want to publicize to their investors that there's like some sort of distress going on. So
yeah, and so the audience, the two that Shakti is talking about, it because of what he's just talking about, like the relationships and the connections and what's going on in the market, and they only buy off. And they're the first one that people call for the off-market deals. One, they got it under contract for 22% below the broker opinion of value, right? And the other one, 25% below the broker opinion of value. Like, that's a pretty huge discount for, you know, it's basically your brand equity has created that for you.
Absolutely. And so, I mean, for us too, we only focus on, you know, I would say maybe 4 or 5 key relationships. I would say those 4 or 5 relationships in the brokerage community control about 80% of the product in the, you know, the workforce housing space in 1980 to 2005. And so when you're that laser focused on 5 relationships, it's a lot easier to manage that.
I think above, just to further emphasize for our investors to understand, you know, the name of the game really is above and beyond, you know, who are the operators, who are the people involved, and what market. This part of the market cycle, buying at the right cost basis, making sure, you know, the purchase price, it really sets us up for success. There are many factors, of course, that go into this, but that was one of the most exciting pieces that I initially heard that makes me so, you know, and it's not easy to source these, as you mentioned, having people that are boots on the ground that have those relationships. I think a lot of folks don't appreciate, you know, maybe if they've come from the single family space or have maybe invested on a smaller scale, it can really make a world of difference. So thank you for elaborating on that.
Yeah, and that's one of our investment criteria as well. I mean, off market is number 1. Number 2 is basis, Amy. And, you know, we're very, very basis sensitive, meaning like, what is the cost per unit that you're purchasing this at? And so, you know, the other piece on basis is, you know, how much below replacement cost or how close to replacement cost are you? And I remember, you know, kind of mid 2021 till Q1 of 2022, sort of the peak of the market, the 80s deals, workforce housing deals, the basis was getting in DFW pretty close to replacement cost, 180,000 per unit. You know, in suburban locations, maybe 190, 200,000 per unit. Austin and some other markets have blown way past that for 80s deals, but also that land is much more expensive. So in Dallas, we were sort of getting up there in terms of replacement costs. Now we're buying that 80s deal in Grand Prairie for 120,000 a door. So, you know, $60,000 less than what it was a year ago. And then a comp just went under contract down the street for 160,000 per unit. That was a fully marketed deal. So there's definitely some.
Yeah, so this is a nice difference in favor of.
Yeah. And I mean, that's what I mean. Like, I would say that, you know, there's a lot of dislocation in the market in real estate still, even though so much of our business has moved online. We're doing this Zoom, you know, so much of the asset, so many things have moved online, but still there's just something something to be said in real estate for being out, like boots on the street, touching and feeling and being with the brokers that it just, it's kind of an old school business in a lot of ways. And in DFW, it's a little bit of a good old boys club.
Well, I see some folks in the chat who are starting to ask questions. So what we're going to do is we're going to switch over and I'm going to bring up some market data. We're going to talk about some resources, and I'm going to have you kind of lead this section of the conversation, Amy. We're going to talk about some resources that you guys can look at qualitatively as passive investors, even as active investors, if you want to go into these markets. And then we're going to shift back into more of the qualitative kind of softer side of market research as well. So the questions, feel free to put questions in the chat, audience. I see one from Todd about Dallas versus Fort Worth, and what I'm about to bring up, we'll talk about submarkets. And then can you discuss entry caps in the Dallas market? Who wants to take that one?
Yeah, I mean, I'm happy to touch on it if you'd like.
Yeah.
So yeah, I think, in terms of the B and the kind of the B and C product, I think we're sort of in that high fours, kind of low fives, tax adjusted entry cap rate, and a little bit more compressed, I would say, in the A space for multifamily. And I'm just speaking about multi. I'm not talking about retail or office or industrial, just strictly multi. But I would say that the A space without any value add is probably 4.25, 4.5. And there's a lot of different reasons and different kind of different factors that play into that in terms of where the price ultimately settles. Right now, there's not a ton of supply on the market. And so I think what we're seeing is that with that very limited supply, there's still a lot of private capital in the market. So if there is a deal that can size to a 60% agency loan, which is another reason why multifamily is still thriving in the private capital markets, is because we have Fannie and Freddie, who have kind of an affordable mission, and it's housing specific. So it's bringing a lot of liquidity and solvency into the lending market in multifamily. Retail doesn't have that. Industrials, office space, none of the other real estate asset classes has a Fannie Mae or a Freddie Mac. And so the fact that we have that in multifamily in times like this, when SVB and regional banks have gone down, bridge lenders and debt funds are out of the market, we still have a source of lending. Of course, it's much lower leverage than what we saw last year, but the fact that we can still get deals done at 55 or 60% leverage now with Fannie and Freddie there is a huge reason that transactions, even though that the volume's down, transactions will still continue this year. And those loans are based off of entry cap rates and going in existing cash flow. So like back to fundamentals of real estate, what actually matters. And I think that sort of got away from us a little bit last year, when you could borrow 80 to 85% of your total capitalization from a bridge lender at when SOFR was 8 basis points. So it's like pretty cheap money, and lots of cheap money. You could pay whatever you wanted. And now you actually have to go back to, fundamentals, like you said, Sarah, cash flow, existing cash flow, going in cap rates, because that's how your loan is sized. So even though the process is, may start at a 5 or 5.15 tax adjusted cap rate, there's so many buyers still in the market, in the private capital market here in Dallas, that may very well compress under a 5% cap rate through a fully marketed process, because there's just very limited deals and a lot of capital still chasing it.
Yeah.
Totally. I always try to caveat it, because it's not always such a straightforward answer, like saying 5 cap. There's like still a lot of different factors that go into that answer. So I always like to be extra thorough. So sorry for being a little long-winded.
No, that's perfect. Perfect. Thank you. All right. So what I have up on the screen, audience, I sent an email out earlier this week about this source. And so what I have on the screen is for Dallas Fort Worth. You can sign up on the, let's see, what is the website? It's just
put it in the chat.
Yeah. Okay, cool. Thanks, Amy.
Yeah.
And Amy introduced this to me. Like she said, she's the queen of market research. And it's cool because you don't have to remember like, oh, I'm going to go look up and do some market research. It comes to my inbox once a month, and it has like 20, I signed up for 20 different markets because it's where we currently are, you saw on the map, and then where we're thinking of going. And it's a good thing to watch. And it's really easy to kind of take a look at what's going on, and then we compare it to what's going on in our portfolio. So what I'd like to do now, Amy, is to talk a little bit about like what are the most important things if somebody's looking at this and deciding like, hey, is this a good market to get into or get out of? And then Shakti, I'd love to talk about what your portfolio is doing relative to these numbers, because everything is relative in real estate and investing. So like there's some cases where the Ashland Green portfolio is doing better than market. And so we'll talk about why that is. And, and that's what makes you guys a great partner. So Amy, go for it.
Yes. Yeah, I appreciate this. This is one of just many resources we look at, right? But, we always want to make sure we're educating and empowering you all to understand, what we're looking at. So again, just one resource, but yes, taking a look at some of the key data points, looking at occupancy, which I know Sarah mentioned, taking a look. Yeah, that's at the very top there. It's also represented on the graph to the right. So if you're a visual learner, you can look at the blue lines there and see how that's trending over time. Taking a look also at market rent and effective rent. So, what the market is and that what operators are actually collecting can be very important to take a look and see how all of this has changed over time. But again, it's not just how it's changed over time within the market, but also compared to what, right? We'd like to look, it's not represented here, but looking at the national rate and understanding, I think some people were, mentioning this in the chat, what is net absorption? What are we understanding about new products coming online? So a lot of this data has context. And it's important to remember DFW is a massive market, right? We all understand this is large. So this is just an average. So if we can look at some of the sub-market data, if Sarah scrolls down a bit, where we can also look at, occupancy, how much that's changed, effective rent growth for these specific submarkets, it can really help us understand what may be going on in an area that we're looking to invest in. Even within the submarkets, though, there's variation, right? Because this includes brand new products coming to the market that's Class A. Typically, that's going to be very different than existing Class B, where it's too expensive. And I think many people understand to build Class B type units. So again, just a general overall view, not necessarily something that's specific to the class of product that we're buying in this specific area. But again, it's a great way to get your toes wet, understand an overall view. And from what we've seen, yes, there's a lot of inventory coming online, but there's so much population growth. And Shakti, you can speak to this better than I can. And we're not necessarily competing with that brand new Class A++ as well. Is that right? Am I characterizing that properly?
Yeah, absolutely. I mean, there's still a huge rent gap between when we're finished with our renovations, because we do value add. So we're buying properties with, if you kind of scroll up in your chart, the delta between our green line for market rent and when we buy these properties effective rent is much wider than what you kind of see if you kind of bring your eyes to the top right corner, where it says, January 2023. You can kind of see that your market rent is probably around 1,500, give or take, maybe 1,550. And then your effective rent is probably, $50 less. We're seeing, and that difference is called loss to lease. We're seeing that much, much wider in our portfolio, especially as value add off market. So just something that's unique about our portfolio, we don't buy deals that the seller's been working on, getting it ready for sale. Sometimes it happens as early as, a year or 6 months before it's going to get listed. And the brokers want to show, a rent roll. They want to show some, what's called burning off of loss to lease. So some leases they want to show, oh yeah, you can take, 20 of this floor plan has been lifted to market. You have, 60 more of this floor plan that hasn't been, brought to market. Our portfolio, when we buy these assets, none of it, sometimes these are just, single owner operators. They're not even in the state, and they don't even have P&L sometimes. So we're basically seeing some rents at, $600, $500, $700 when the market rate is 13. And we had some renewals last year where we went up 50 to 60%, and we're still able to maintain 95% occupancy. So I mean, we were seeing huge below market rents in our portfolio. But obviously this is the types of deals we're buying is not your typical deal. It's very, pretty hard to find an off market deal. So I would say, just sort of answering the question before about comparing what we're seeing in Fort Worth versus Dallas. I think there's a couple things. I think number one is, I think the rent growth, I would completely agree with this chart in terms of what's happened from, the start of 2021, where rents were closer to $1,200. And now we're at, $1,500. I would totally agree with that sort of 20 to 25% rent growth during that 2-year period. I think what we saw in Q4 was a softening, a pretty considerable softening in the last year. In fact, there's only been
across the US, actually. Yeah.
absolutely across the US. Yeah. And so, so we saw a softening. I think in the last year, it's only been about 0.4% rent growth. And so obviously I think that's a good thing because, that's a big factor that feeds into core PCE, which is what the Fed looks at when they decide if they're going to raise rates or not. So, we started seeing that in the fourth quarter of last year. And the Fed will probably start seeing that in core PCE. And I think they probably already have in the latest inflation readings. And so that's why they're projecting that in June, the Fed will most likely do nothing and probably start cutting rates by the end of this year when that core PCE starts really tapering down. But what we've seen is that there's been a huge, a big pick. Well, let me just answer the question. The softening in Fort Worth was, I thought, greater than what we saw in DFW. And I think some of that, you had a market down there showing South Fort Worth, if you want to scroll down. So South Fort Worth, we have a few properties down there. We saw, our biggest softening in that submarket, even though it's in your top 5 submarket for workforce housing. We certainly saw a slowdown. So we really turned down our rents. And what we've seen sort of in the last, 3 months is sort of when leasing season started. It's kind of March, things start warming up around DFW, and that's when the leasing picks up. But our portfolio is trending to about 93%. Our Dallas properties are a little less price sensitive. It seems to absorb our renovation premiums a little bit easier than the Fort Worth market. I think that could be a function of it, proximity to, major employers. And that's why, we've learned some lessons as well. We're a little bit more conservative when it comes to property taxes in Tarrant County. So that's kind of a factor that we always consider when we're underwriting. But, we don't know everything when we underwrite these deals like you, Amy. We do a ton of market research, but sometimes you don't always nail it perfectly. And, that's one of the reasons we like to be local and vertically integrated, because when we do miss, we can correct very quickly. And so that's what we've done on those assets. So we kind of paused our increases and we really focused on getting our occupancies up. And now that we're back in leasing season, we use what's called revenue management. So we've sort of slowly started toggling our rents up a little bit because we're, through the winter months, we were sort of managing for occupancy, and now we're managing a little bit more for price now that we're a little closer to 95%.
And, that's pretty impressive, actually. So I'm going to scroll back up here. If you see occupancy in the greater area, if you average across all the submarkets, this is saying it's 90%. So that was one of the things when we were talking with Shakti and Alok, who you guys will meet on Monday, is like, hey, occupancy has gone down 3% since last year. This is that first data line you see on the screen. It's at 90%. How is your portfolio doing, and how has that affected your portfolio? And so their properties are ranging, correct me if I'm wrong, 92 to 95% occupancy. So that's actually considerably higher than what's going on in the market. And then you guys said it's due to the fact that, you're vertically integrated, so you have more control over and more passion for getting the numbers to where they are. So I think that's pretty cool. I also want to point out, so you guys, we have about 5 more minutes. I'm going to switch over and show you how to access next steps if you want to join us on an investment we're doing in this market. But I want to point out 2 more data points. The rent per square foot, or the asking rent. So this is an average. Where would you say for your portfolio and I don't know if you have this number off the top of your head. I didn't prep you ahead of time, but what is the asking rent for your portfolio? Is it pretty much in line with what you're seeing? We're seeing this like the 1.78 or higher, lower?
So it's probably just a tick under. The new deals that we're bringing out, one of them has a 2005. One of the two deals is a 2005 vintage. So that deal is currently at about $1.90, and we're taking it to $2 a foot. And then there's another deal in there that's a little bit older, and we're taking that from $1.70 a foot to $1.91. But I would say our portfolio is probably in that $1.65 to $1.70 range right now. You know, like I said, we're really managing for occupancy at the moment. And then we're slowly sort of pivoting now that we're close to 95 to get to start turning up rents. I think if we went to $1.78, we may be closer to 90. But we're just, you know, occupancy solves a lot of problems, especially in an environment where, you know, bridge loans is getting more expensive. So it's really important to keep these properties full, even if you're not getting, you know, every last dollar on the rents.
Yeah, that was perfect. And so audience, I hope you can see how it's good to look at all the numbers when you're doing market research, because you can see how changing one will affect and change the other. So, you know, if you're looking at other markets or other offerings out there, you're going to want to look at all the data to see how one is affecting the other. Another one that kind of, when I was looking at Dallas, I was like, this doesn't look good. It kind of turned me off from the Dallas market is the concessions. So concessions, I'd love to hear, Shakti, what you guys are doing for concessions and what you guys, like 133% increase in concessions is really big, 19% in the market. Are you guys needing to do that to get your occupancy up to where it was?
So I think you're probably seeing a lot of deliveries that came on last year that are probably in lease up. This includes all product types, right?
Yep,
Lease up
it
deals
does.
as well. So yeah, I mean, obviously all the lease up deals are trying to go from 0 to 90% in the shortest amount of time possible. So I can bet you that 90% of that, you know, 20% of concessions, 19% of concessions is coming from 2021, 2022 lease up deals, 2023. We don't use concessions throughout our portfolio. It actually messes up our revenue management system. So we don't actually have concessions. We actually manage just to pure price. You know, we may waive like an app and admin fee, you know, $50 to $150 when they're signing up for the deal, but we're not giving, you know, 2 months of free rent away or anything like that. So I think you're probably seeing that more in the newer core A+ space, where obviously Dallas has always been a place where you can just continue to build out, and you know, everyone here likes to build. But like you said, I think when you said, you know, there's a lot of movement and inward migration. So, you know, unlike an Austin or a Nashville that right now is way oversupplied. So you're going to see a lot of cap rate expansion. DFW, Dallas and Fort Worth, supply and demand are pretty much in equilibrium over the next, you know, 3 years. But you are seeing most of those concessions are coming from the new product.
That's a good explanation. Thank you. Appreciate that. Because yeah, when I did see that, I was like, oh, I don't know. That doesn't seem like it bodes well.
Yeah, and you know, that's one of the reasons we kind of, you know, stick to the value add, because as a vertically integrated management company where we're trying to create alpha for our investors, like, you know, investors are investing with us not to just go buy a pretty property and sit on it for 3 or 4 years and return, give a bunch of concessions, don't do any capex, and then return, you know, 10% a year. You know, we're getting paid to roll up our sleeves, you know, put elbow grease, and just, you know, it's these value adds. I mean, we're taking these pretty tough properties and we're turning them around, and that's how you can create value. So we've looked at new deals. If it's a lease up deal like the one we bought last year, where we're buying direct from the developer and we're getting a huge discount to what we would be paying in the market, we can justify that and we're taking rents up. But generally speaking, you know, buying a stabilized, you know, A+ deal, we just can't do enough to create alpha and create those, you know, 25, 30, 35% returns. So we kind of stay away from them.
Yeah. Cool. All right. Well, audience, I'm going to switch over and we're going to talk about specifically the new acquisitions. I mean, we kind of hit on them broadly. But like I said, we're going to partner with Ashland Green, and it's a two property portfolio that we're partnering on. So Silvus Capital, Sigo Capital, Ashland Green, we're going to all co-GP. So if you guys go to investwithsarah.com, it'll bring you to this page. So we're not going to run through the business plan, but I just wanted you to know it's a resource. We're going to have the business plan webinar next Monday. So we'll have Shakti back, and we'll also have his business partner, and head of investor relations. And they'll go through the business plan. We'll go through it together. But I wanted to give you this resource. So if you go to investwithsarah.com, you can go to the data room and start looking at information to prepare. And let me give you the link too. I'm going to put it in the chat, the link for the webinar on Monday. So Monday, you can register here. It's in the chat. And so it'll be the three of us back on +1. But I want to go to the, I don't know if I can make this bigger. There we go. All right, the map. So I didn't put the exact address of the properties in here, but since we did touch on markets and submarkets, can you tell us a bit about the submarkets that the two properties are in? Where are they on this map, and a little bit about them for folks?
Yeah, sure. So if you want to zoom out a little bit, the first property is in Grand Prairie. That's to your left. If you kind of take your eyes from that red circle across I-30 to the left, you can see it says Irving up, and then it says Grand Prairie. So this property is a 1980s construction in Grand Prairie. As you guys know, we're right next to Arlington, and that pocket of, you see Bedford, Euless, Irving, Arlington, Grand Prairie, that's all called mid-cities. The reason it's called mid-cities, it's because it's equidistant between Dallas and Fort Worth. We own a lot of properties in that submarket. You've got, the GM plant over there. You've got Texas Live, you've got AT&T, you've got DFW Airport and all the jobs in that area, in the Irving area. Wells Fargo Bank is moving here. Caterpillar just moved here. So tons and tons of jobs, a lot of blue collar jobs in the area. Median income in the 1 mile radius is about 58,000. So good demographics in that location, and just a solid sort of B workforce housing type of product. The other deal we're buying is just to the north. It's actually in Dallas. So if you kind of scroll up, some of you that have been here or that live in DFW are familiar with the Galleria. It's sort of where it says North Dallas right there. It's at the intersection of 635, which is right above where it says North Dallas, and the Dallas North Tollway. So right where it says Inwood right there. And that's, tons and tons of office space in that area. You've got the Galleria, and then you've got what's called the Platinum Corridor, which is all the jobs that are being created around the tollway. So that's kind of I would say, a newer strategy. We're calling it our Restore to Core. So that one's a 2005 construction asset. And when we say Restore to Core, we basically mean that we want to do condo spec finishes out in the inside of the property. So a slightly higher level of upgrade, and then bring it up to that 2015 to 2020 level, but still be $200 cheaper. So that's kind of our newer product. It has a bunch of retail in the space as well. We're not purchasing the retail. We're just buying the multi, but a lot of office in that area, a lot of connectivity to the rest of the Metroplex. So a lot of exciting developments happening in that area as well, which we'll get into during the business plan overview on May 15th. But, right now, I think, given sort of there's a lot of private capital, like I mentioned, in the buyer, in sort of the buyer pool, but a lot of the institutional equity that normally would be purchasing a 2005 construction asset across from the Galleria, they're pencils down right now.
Yep.
So to be able to sort of, it's great for us because we are private capital, and we have, 200 some odd investors that are looking to invest in this deal. These investors aren't going to have opportunities to invest in those vehicles. And so it's for us to be able to own this quality of asset in this location. And, that deal was in contract for $55 million last year. and the buyer fell out because of the market. Then went a contract again for 48 million in October. That buyer fell out, and so now we're buying it for 43 million. So to buy something, large units over 1,000 square feet, and structured parking, so not like our typical garden suburban where it's surface parking, so completely different type of product. To be buying that at 212,000 per door, to build that again would be 300,000 per door, and the comps are almost 275, 280,000. The one across the street's in contract for 260,000 per door, and ours has 250 square foot larger units. So really good sort of opportunity. We're also putting Freddie Mac loans on both with flexible prepay. Our average hold time is about 2.8 years. We model a 5-year hold in all of our projections. But if we can have a capital event after 3 years, that's our preference. It depends on market conditions, but we want to get capital back to our investors as quick as we can. So, we see this as a really good opportunity to buy in a soft market. And I think, the projections are by Q1 2025, we'll be back at pre-recession level pricing for multifamily. So about 12 quarters from when our recession started in Q1 of 2022. So we think that we'll be pretty well positioned for a capital event in 2025, 2026.
Cool, perfect. All right, so I'm going to show you guys some more information. So again, if you go to investwithsarah.com, so we have both investors who are currently investors with Silvis Capital, investors who are Sugo Capital investors. Everyone's on here. Everyone can still go to this website, investwithsarah.com. And then what we're going to do on the back end is, those who know Amy can talk to you about it. Those who know me, I'll talk to you about it. And then on the back end, if you guys are, after you come to the webinar, going forward, then Ashlyn Green would also jump in and talk to you guys about stuff. So just so you know, since, everyone's kind of from all over the place. But if you go to investwithsarah.com, then it has information. Team, we talked a lot about the team already today. Market is pretty short in here, but we just spent an hour on the market. I'll also put a link to this webinar on this webpage. It does have some more details about the 2 different properties. And again, we'll go into that on Monday. And then it has a next step section so that if you want to come to the presentation on Monday, the 15th, you can register. So go to investwithsarah.com and then you can see the link to register. If you're already excited about it after you review the information in the data room, you can place a soft reserve. And then what's going to happen is once the subscription paperwork is ready, then Ashlyn Green would email you the subscription paperwork to sign and get through the investment. But there is data here for you guys to look at. And then also when you go in, it's kind of hard to see, but you can see overview is selected right now. If you click on documents, there is also the full, I don't know, it's 50 or 60 page deck with the full business plan for the 2 properties for this portfolio. So feel free to click on that and review it ahead of time so that when you come to the webinar on Monday, it'll be more like review, and then we'll have an extensive Q&A amount of time for Q&A. So you can ask us any questions. So I always encourage people really look at that material before the webinar so that when you see us explaining it, it's more like answering your questions. It's the second time you hear it, so you'll really understand the business plan and the investment opportunity. And then also you'll be able to come prepared with your questions. So again, it's investwithsarah.com. We'll bring you to this page. And then also in the chat, you can see the link to this and you can register, and we'll talk more about it on Monday. All right, with that, I'm going to stop sharing my screen and we can move over to Q&A unless Amy or Shakti, if you want to say anything else before Q&A.
This was fantastic. Thank you, Shakti and Sarah. I think we're getting lots of great feedback here in the comment section about the ALN resource. People are excited about this market. A few people I know that know this area. My friend Melinda, my longtime friend, lives in this area, and it's just, she's like, oh my gosh, it's such a hot, great area. So I'm just really excited about the opportunity.
Cool.
Yeah, and I'll just say that from my perspective, of course, we're excited to partner with you guys and get your investors exposure to these assets. We're raising about 25 million on this. We never know exactly kind of what's going to happen until the day of the webinar. But like you said, Amy, just echoing your sentiments, just from sort of preliminary conversations, there just hasn't been a lot in the market. And then what you'll notice about Ash, so there is a lot of sort of pent up capital that's looking to be deployed. And then what you'll see from Ashland Green in our reporting, which, Sarah and Amy have really diligenced quite a bit over the last 6-7 months, is just our transparency. So you'll notice that when you come with us, I'm a very straight shooter. Everyone on my team is very straight up. You pretty much ask us a question, we're going to tell you the good, the bad, and the ugly. We don't try to cover anything up. If something bad happens, we give you the news right away. And, it's kind of just kind of easier that way. And, I think our investors appreciate that. So yeah, really looking forward to answering questions, being back in the webinar on Monday, and then of course, partnering with Sarah and Amy and all your investors.
Yeah, and I appreciate you having this available and being open to partnering with us on this, because yeah, we haven't seen any good deals in a while. Like everything we've been saying, it's hard to find something where the numbers work. There's stuff for sale, but it's hard to find something where the numbers work. And so, yeah, we were super excited. And I was like, wait, we have something. Yay, let's partner.
Yeah.
So we're really excited. And then I do want to echo for everyone who's, thinking of, investing in multifamily and which operators to choose. Shakti and his team, what he said about being transparent is totally true. And I find that with our investors and our other funds, like just be transparent. If investors don't hear from you or if they don't hear the full story, like they get the sense, they can tell something's going on. It's just so much better to just like be completely transparent in the long run and we're all in this for the long run. We're not trying to, make a couple million and bounce in the next year or two. Like we're building a legacy with our 3 companies. And so, our brand of transparency and honesty is really important to us at Sugo Capital. I know at Silvis Capital with Amy and her investors. So I appreciate that Ashland Green has that same, that's part of their culture. And I appreciate that. So I wanted to let all the audience know that's what we've experienced. And if that's important to you, then you'll find that with this group on the screen. All right, questions. Take it away, audience. Amy, you want to lead questions? I feel like I talked too much.
No, you're great. I saw a lot of people very eager asking about 1031 exchanges. So is that an opportunity for this fund? What does that look like, Shakti?
We've done them before. Usually it's in a tenants in common structure, so a TIC structure. It was like what we did on Fiona, and we currently don't have this deal set up as a TIC, but for your 1031 investors, Amy and Sarah, let's sort of see if there is some other opportunities where we can work together. But let's talk offline because I don't think we've ever had that discussion. But we've done them before. We're not going to be doing it on Fund 6, but if you have somebody with a clock, we can let's get those names together and let's the 3 of us with All Oak talk.
Okay.
Thank you.
I'll also say if you're a Sugo Capital investor, we have 2 other opportunities for 1031 exchanges that are open right now. So if you have something and you're needing to identify and you're in your 45-day period, contact me. I have 2 options that would be open to you. And great question, Todd. Yes, this is open to accredited investors only. This is a 506C. Todd, you passed your test, right? You're accredited now? I believe so. I think that's what I remember from you. Question, can it be done from an IRA? Yes, sold a 401k, IRA, trust. Oh, no, not yet. All right, sorry, Todd. But yes, Dan, nonprofits, trusts, LLCs, all those are possible investment vehicles to join. Minimum investment, 50K. So we have been offering 100K minimums for like the last 12, 18 months. So for those of you who've been asking, hey, what if I have 50? This is yours. This is your investment. You can come in for 50 and above. And there's a Class A and Class B actually. And I don't have that slide up on the screen anymore. But there's a little bit higher return if you invest 250K or more in this portfolio. So know that, and we'll talk about that on Monday, but just so you can start thinking about that.
Dan, cost seg. Yes, Shakti, let me know if I'm talking out of turn, but you all diligently do cost segs. Is that correct?
Yes.
First year? Yeah. Very important.
So we'll be doing it on this deal. Of course, it's no longer 100% bonus depreciation. We're sort of phasing into the 80% a year this year. And so we'll be addressing depreciation on the Monday event as well in one of the slides.
Perfect. I see questions about what are the numbers look like. So I'm going to pull it up on the screen. So 50K minimum, hold time 3 to 5 years, projected returns are 6% cash on cash. Equity multiple, you see a range because, I mean, everything isn't a range, but there's a class A1 and A2. And so they have a different range. But year one depreciation, the projection is 65%. And the average annualized return, 18 to 21%. I think I do have it here. There we go. Sorry, not A1, A2, but class A, class B. So there are the returns, and I'll leave that up while we keep going through the chats.
Kevin's got a great question that I know is on my mind about how are we mitigating, what's going on with what they're hearing about property taxes in Texas, insurance. I know you guys have all this handled, Shakti, but maybe you can talk us through a little bit about that as well.
Yeah, those are great questions. With Village on the Green specifically, we're actually, much, much lower than what we normally see. And that's because there's an HOA that handles the retail component. So we're closer to, I think, even with the increase in their renewal, we're closer to about $450 per unit per year, which is incredible. And then we're underwriting insurance at closer to $850 to $900 per unit on the Grand Prairie deal. We just renewed our entire portfolio. It's under one master policy. We just renewed it last week. Actually, Cinco de Mayo was our renewal expiration. So like literally last Friday, and we're at about $900 per unit per year. So it's in the underwriting. Just to give you context on that, when we started buying here in DFW in the summer of 2017, we were underwriting and getting insurance at $300 per unit per door. So it's up 3x.
So it's painful.
Yeah, and then on property taxes, Dallas and Tarrant County values just got released over the last several weeks. We're working with the property tax consultants for the sellers. And so we've had calls with our property tax consultant and their property tax consultant this week, actually. And so we're working to get values down in June before the closing in July, so we can get our property taxes as low as possible so we can maximize our proceeds from Freddie Mac. But obviously with all our portfolio, we're going to litigate, and property taxes did come out very, very high this year. But given kind of the changes in market conditions from a year ago till now, I think our property tax consultants feel pretty confident they're going to be able to get values down to pretty close to what they were last year. So we're working on it, and it's pretty active in terms of our management. We're pretty in the weeds on that. And we're sort of managing, I wouldn't say micromanaging, but we're kind of managing the seller's property tax consultant as well to ensure that we get best proceeds. But ultimately, this whole thing will go through litigation. And we're just settling on values from last year now, and it's May, and we still haven't even settled all of Dallas yet. So it's going to be a long process, but we do it every year. And it's in our underwriting.
And I love that you say that. You've got experience. This isn't your first rodeo, to use a Texas analogy, with your portfolio, right? You know the game, you know how to play it. And of course, the second pronged approach, other than your experience, is you're anticipating this, right? It's baked into the underwriting and the assumptions. So that's what makes me feel very comfortable about, what we're seeing in the market. Thank you.
Yeah, absolutely. It's a good question. Great question.
Yeah,
Thanks,
really good market research question that you should ask about any market you're going in. Taxes and insurance. All right, so going back over, what are the splits with the sponsors fees? So what you see on the screen, Jim, is net of all splits and fees and everything. And we'll go through, if you can go ahead of time to the deck that's in the portal, and it has all the fees listed, and we'll go through it on Monday as well. But what you see on the screen is net of all the splits and fees for the investors. Are the distributions quarterly, monthly, and when do they start?
Good question. So we do quarterly distributions, and they usually start 3 months after we close.
And it's a little unique what Ashland Green does. And so can you talk about how are you getting to the fact that it's going to cash flow so quickly, whereas some other operators might not cash flow for 9 to 12 months?
You mean specifically with Ashland?
Yeah. And for this property, how, you raise a bit more in order to do some cash flow front.
Yeah. So, similarly to what, how new development does it, we've done one new development deal. They raised basically an interest reserve, to pay the construction lender while the property is being built. So there's no cash flow while the property is being built. But they're able to still pay their mortgage through that interest reserve. So we do something similar. It's called a distribution reserve. We raise that up front. And we put it all into our underwriting as well. But that kind of helps us give the cash flow a little earlier in the investment life cycle while we're going through the value add rehab.
Perfect. Thank you.
Brian's oh, sorry, Sarah, go ahead. Go ahead.
Cash, I see you're asking where are the subscription documents? So they're still in the works, or they're not in here yet. But if you're at investwithsarah.com and you see what I have on my screen, kind of just under the word value, you see the word documents. So when you click on that, what is available right now is the presentation that we're going to give on Monday. So the details, all the details are in there, but the subscription docs, the legal docs, won't be ready probably till next week. So you can still put in a reserve, and then but then there's no further action to take. And then when the subscription docs are ready, then you'll get an email from Ashland Green saying, okay, they're ready. You can come in and look at them now. So hope that answers that. Man, if you don't understand, come on Monday and we're going to go through in detail. We'll spend an hour talking. Mm-hmm.
Yes, recording will be available. We'll make sure to get that out to you via email. Thank you.
Yep. All right. Did we get all the questions, Amy? I was kind of all over the place.
We got a lot of them. Yeah. I know we're 8 minutes over. I'm not sure if Shakti has another appointment to go to.
No, I'm good.
Good. Okay, good.
Yeah, you guys have some great investors and awesome questions, and seems like they're super excited about the deal. And I love the way you guys have such a relaxed sort of way about engaging. It's a lot of fun.
Yeah. Like I said, we're not a fluffy investment firm.
Teresa's asking recapture and exit. I'm assuming you're referring to depreciation recapture. Is that right, Teresa? I don't want to speak for you. Yes. Okay. So you're asking if there's depreciation recapture at exit. Shakti, you want to take that one?
Yes, I don't like to give tax advice. But yes, we're going to be using accelerated depreciation through our cost segregation study. So we're going to be issuing K1s, and we'll be showing losses on those K1s. So how you take those losses obviously will impact how you take recapture on your exit. I don't know if that helps, but yes, there will be if you take the depreciation up in the front in the 2023 tax year. Again, I'm not a CPA, so consult with your CPA, but yes, you would have to take recapture upon the exit. Yes.
And that's an overall tax law, not specific to this particular property, correct? Yeah. So that's definitely something that is not unique to this. Let's see. Brian. Oh, go ahead. Sorry.
I see a lot of people saying they couldn't access the deck. I just changed a setting in the portal. I had it marked as not allowed to download, but I just clicked it. So now everyone who is trying to look at the deck, try again and let me know. You should be able to see it now.
Brian Cook, my friend Brian, is asking, what is the percentage of value for property taxes? Are you asking, Brian, I think I need a little bit of clarification in terms of what exactly you're asking. Are asking what the assessment rate is? Let me know in the chat.
Yeah, we're on both of these properties. We're over 100%. And we're underwriting anywhere between settling and between 85 and 90
Okay.
And that will happen through the litigation process.
Gary is asking what year-end tax docs and when received. What year-end tax docs? So you should receive a K-1 annually.
1st. April 1st is our goal. Yeah.
Yeah, you guys have done great with that. It's not everyone is able to get those in time, but that's been a great experience with you all as well.
Yeah, I got them so early. I was like, wait, this must be a mistake.
we have 1,400 of them, and so it's a process that sort of gets rolling December when we close books. We want to be the first ones in January to get to our tax preparer.
Smart.
And try to get on their radar so we can be first to get them out.
Love it. Good strategy. G is asking about IRA or solo K is not ideal to use for tax benefits. Again, we are not CPAs, so please definitely make sure you check with your tax professionals. But yeah, that is a already tax sheltered investment vehicle. I know myself, about half of my investors still use their retirement accounts to invest because they're interested in getting diversification and not to have all their retirement exposed to the stock market. But that is a highly individual thing based on your goals and your risk tolerance.
I will say if you have both, if you have an IRA and a solo K and you're trying to decide which one to use your solo 401k. Disclaimer, I'm not a CPA, check with your CPA, but that's what I would do because you don't have UBIT in your solo 401k and you would have UBIT in your IRA because this is a leveraged asset. All right. Anyone else have any questions? It can be personal too. You know, it's the first time you're meeting Shakti, so feel free to ask personal.
Somebody asked what my last name is.
Oh.
Should I type it into the chat box?
Yeah.
Yes.
All right.
Thank you. There it is. Oh, G already got it.
You already did it for me. Thanks, G.
There we go. Beautiful.
Yeah, when we send out the replay, it will be in
market research, G. Yeah. What's my birthday, G?
We encourage stalking here. Yes, of course. We're all a big family.
Shakti, are you guys on Veravest.com?
Is that like the third-party verification?
Yeah.
I think we're using Parallel Passport on this one. Have you guys had a good experience with Veravest?
Well, Veravest, so it verifies the sponsors and does the background check on all. So it's not for investors, it's for sponsors. So that it's a due diligence tool for investors. And so Sugo Capital is on it. And so, I mean, I paid them, but then it was basically, they did a full background check on my company and me and any principals in the company and any head of departments and made sure they do a full background check to make sure we didn't have any fraud or bankruptcy or, yada, yada in the past. So it's easy for investors. Then they don't have to do a background check on everyone they see on the screen. They can just go to veravest.com. So Ashlyn Green should get a profile on there.
That's a good idea. That's a good.
You have one, Amy, or you don't?
I don't.
Okay. And then they do it. The cool thing is too, so then you get a stamp on veravest.com. So it says Sugo Capital and there's a stamp and it says Veravest verified, which means they did all the background check. And then they redo it every year. So I just got my notification, hey, you need to pay us the money again because we're going to go do your background check again. So I'm not paying to get a check mark. I'm paying to go do all the work on me. But they do it every year. So, it's not like just because someone's up there that, they might have been fined 5 years ago and now they have some fraud. Like it's updated every year. So it's a pretty good resource for investors to do due diligence on sponsors.
I like that. I didn't even know that existed. Now I learned something new. So yeah, that's something we'll look into. Appreciate that.
For those of you asking for any follow-up, the replay is going to be sent out. So Amy will email it to all you guys who, are with Silvitz Capital. I'll email it to all you guys who are with Sugo Capital. So you'll definitely get it. It'll be up in the data room. There'll be a link to it as well. So, yep.
Great question, Carlos. Distributions from distribution reserves considered return of capital, I assume? If so, does an invested capital decrease over time?
I don't want to give a wrong statement on that. So if it's okay, Amy, let me get back to you on that. It's a good question.
Please. Yeah, well, we'll make sure we get that answer, Carlos. Thank you.
And I believe I know the answer, because I asked, I believe it's not considered return of capital. That part we can verify, but it's not like now you put in 100K and now some of it's returned. So now you're only going to get your 6% cash flow on, $96,000, whatever. It doesn't decrease your position. I mean, we can get back to you on that. And I think we should have that in the FAQ section, when we talk next week.
Yeah.
But I believe the answer is no. But, all right.
Absolutely. Gary is asking if accredited, verified with previous investments, do we need to go through the process? So I think, Sarah, you mentioned this, that the SEC has changed the timeline that a verification document is valid for.
Yes, and it depends on how you were verified. So like if you're an accredited investor by net worth, it used to be, if you got a letter, it was valid for 3 months. I think now it's valid for a year, but your letter should have a date on it. And especially if you go through Verify Investor or one of those third parties to get verified, the letter that you received will have an expiration date on it. So if you were verified because your income is over $200,000, that used to be, I believe, valid for 1 year. I think now it's valid for 5 years. So go back and look at your letter and it should have an end date on it. And then, because I think the rules changed like 6 or 12 months ago. So whenever you got your letter, it should be like the new rules should be incorporated. However, if you had your CPA sign it or something like that, sec.gov, we can look up the rules. We can see if it's still valid. But yeah, it did recently change. So if you do have a letter, you can use that. You don't need to do it like each time you do an investment with us. So for those of you who recently invested with us on some other investments, if you still have that letter, we can use the same one.
And we've been talking, Sarah, to our new general counsel on this because we kind of heard the same information.
Yeah.
He was erring on the side of caution and said,
Okay.
let's just re-verify everyone. But I think it's probably worth us just touching base on it. And just maybe we can put that in the FAQ
Okay.
and just be sure, because he's here to keep us all safe. And so,
Yeah.
Good.
but I
an investment like 2 months ago. So if people have a 2-month-old letter, that's probably still okay.
Yeah.
I would think. But yeah, we'll have that in the FAQs on Monday.
Okay.
Yeah. Is the SEC changing the min wealth value for accreditation? I don't think so. I think they're raising it. I don't know though.
I don't think she means lowering. I think she's maybe, if I could be wrong.
Changing, excuse me.
Yeah. I don't think they've done anything yet, but it's possible. But nothing as of yet.
Yeah.
All right.
Okay, so the only personal question we had for Shakti was, what's your last name? No one else had anything personal, like, hey, do you have any kids? What's your favorite hobby? Go.
Yeah. Where'd you go to school? Does he feel allegiance to California over Texas?
I don't-
California.
okay, so
Watch your
Yeah.
audience. Watch your audience. No, I'm kidding.
I've got 2 kids. Yep, you're right, Mark. You're paying attention. I've got an 8-year-old and a 4-year-old. And girl and a boy. Let's see. Do I feel allegiance to, what was the second question? Oh, I went to school at UC Berkeley and I went to master's at Hopkins. And I feel some allegiance to California. I actually, fun fact, used to intern. My first internship on Capitol Hill was with Senator Barbara Boxer.
Wow.
Yeah, so fun fact about me, but I don't know. I'm in deep over here. I don't have cowboy boots yet, but I sometimes say y'all. But I still love visiting California. You can't beat it. It's beautiful. And the weather, it's just so expensive to live there versus here. So.
Well, spoiler alert, I think we're going to figure out your shoe size and send you over some cowboy boots when we close this deal. So
I love that. That'd be amazing.
just saying.
Maybe one boot can say Sugo Capital and the other one can say Silver Capital on it.
Lucky you.
S&S, I love it.
Oh,
Yeah, his hat size too. Yeah. I did actually. I went to the rodeo this year.
How
I
fun.
wore a cowboy hat, and I've got like some makeshift boots. They're from J. Crew, but they're not like cowboy boots, but they could kind of
J. Crew
pass.
doesn't sound cowboy.
They're not cowboy boots. They're just like brown, like Chelsea boots, and they kind of look like. I kind of loved it. I kind of felt it's like when you dress up for Halloween. It was like a whole different persona. It was nice. I liked it.
That's fun.
So maybe next webinar I'll wear a cowboy hat and see what happens.
Ooh.
Say less. Mine's right over here. So just be careful. We can all do it together.
Let's start the
And if we
webinar.
do it, we'll all do it together. You too, Sarah.
Okay,
Maybe at the
probably
beginning,
not.
maybe at the beginning of Monday's webinar, we'll start with cowboy hats.
done.
I'm in.
I'm in.
I'm in. Ooh, this is interesting. G doing her stocking work. Thank you. Something about you made 40 under 40.
Yeah. So yes, I'm 42 now. But yes, in my last year as 40 under 40, I sort of told the story of launching the property management company in the summer of 2020. And oh wow, you beat us to it. That was quick.
We have to do it. Sorry. Continue on.
That looks good. Yeah, anyways, so I got nominated as 40 under 40 and then was admitted into that. So that's kind of a cool little thing you'll learn about me if you stalk me a little bit online.
It's impressive.
And one of our deals actually was nominated as a finalist, our Fund 3 for Best Deal of the Year. We were in the top 3. Yeah, it was a deal we closed in January 2022. It was a 5-property portfolio that we closed on one day. It was 4 different brokers, 5 different sellers, 5 different title companies, and we closed it all in one day. And it was an insane, crazy day. And actually, about an hour before the deadline, the wire cutoff deadline, my team called me and they said, we just walked the units at this property, one of the 5 properties we're buying, and there's some down units, and just letting you know if we want. And all the closings, there's a credit from the seller. They're going to owe you $20,000. And this is a $250 million transaction. And it was a $20,000 credit. It was 1 p.m. Wire cutoff was in an hour. What do you guys think I did?
I would have said, forget the 20K.
No. We had everyone redo all their closing statements, and we got the 20 grand back, and we made the wire cutoff. Everyone was pretty mad at me, but it's $20,000.
Wow.
Well, see, you're in the right seat then.
So fun. You guys are learning all kinds of fun facts about me.
Yeah.
Keep going until there's only one attendee.
Right.
I think that's going to be a long time because there's
They're all in on
still
Sue
160 people
Capital.
here. It's all... Oh, all right.
Mark.
Well,
Wait, can we answer this question from Mark Berger?
okay.
The beloved. Hey, Mark Berger.
Beloved.
So he's the SoCal friend. We have lunch. I'm a big fan. He says sometimes on the ground sponsors look good on paper and presentation when entering a deal, but go silent during the course of the deal when things aren't going great. What precautions do you take as sponsors to ensure you represent the investors throughout the process?
So I would say number one is we do a lot of things differently over here at Ashland Green. And one of our kind of number one, we actually have something called the Ashland Green Way, and it sits right on my desk. And the first one is your word is your bond and managing expectations. So this is like I don't know if you guys saw that movie Air. It was about Phil Knight and how they signed Michael Jordan. Anyways, it's a long document. He's got like 10 or 15 principles above his desk where he built Nike. This is like 15 rules of how we conduct ourselves at Ashland Green. It's called the Ashland Green Way. The first one is managing expectations. Your word is your bond. When I took investor money in 2017, 2 years later, I stopped drinking because it's not my money. So I've not drank for since the summer of 2019 when I moved to Texas. And the responsibility, the fiduciary duty, take it deadly serious, way more than my own money. Investor money is, and we have all our family's money in it, in-laws, cousins, brothers, you guys, friends. And so we take the obligation of communication like deadly serious around here. One of the things that we do that's different than any other sponsor, and I don't think anybody has seen this, but we do a kind of an earnings call. It's a quarterly asset management webinar, and every single quarter, it takes us a long time to prepare it. We don't talk about new deals very much. We don't pitch. It's not a pitch. It's not like, oh, we're, the only time you see us is when we're pitching a new deal. It's fully an asset management webinar. We go over cash positions on every single deal. We talk about property performance, what's happening with rent growth, where we're falling short, where we're doing well, things that we're looking to improve. And that's me, my COO, and our head of investor relations. We have our camera on. It's usually a 2-hour process once a quarter. So that's slightly different. Our financials have variance notes in it. We have 10 people in our investor relations department that are super active. If you email us, you'll see that we'll respond pretty quickly. If you guys have questions about, P&L, we have no problem looping in whoever we need to from our team to answer those questions. But, we raised quite a bit of capital last year, 75 million. And like I said, we have 1,400 K1 investors, and a lot of those are repeat investors and sponsors that have, or investors that have been with us for a long time. And like I said earlier in the webinar, transparency, communication. I'm a very direct person, very plain speaking. If you ask me a question, I'm going to answer it. And my whole team is like that. So we're going to tell you guys the good, bad, and the ugly, and it's value add. And there are challenges for sure. And we're pretty upfront about it, right away. So I hope that answers the question.
I love it. And I have an investor who is saying, Sarah, you should do that for all your properties. They're like, come on, Sarah, be like Ashland Green. We'll work on it. We'll aspire to it. Thank you, Stacy.
Yeah. Yeah. And I could keep going on about that, but there's many instances where people in the company tell me like, this is the best place I've ever worked because there's no politics here. When I go home, tell my wife about what happened at work today, I'm never worried about anything because I know we just work really hard when we come in, and at 5:30 when we leave, it's like the job's done, and we'll pick it up tomorrow. But it's very, very much a meritocracy in terms of our culture over here. And you guys are talking to me for almost an hour and a half today. Investors can see we've been talking for 8-9 months now, and you guys know I'm pretty upfront, pretty direct. Like, just whatever you want to ask, you can ask it, and I'll tell you the truth. How do you get a job there? I don't know, Mark. If you're accredited, I probably can't afford you.
Brian's wondering, I love this question. Is there money savings with going vertical for property management?
So property management is a money loser for us every year. It doesn't break even until you have 8,000 units. On paper, you think you can run property management with, a regional, maybe outsource your accounting and, asset manager, and you can run it with like 5 or 10 people. I mean, we have 50 people at the corporate office here, and we have 120 employees out in the field. And, a big part of our business is learning and developing these employees, because they come in with different skill sets, and we had to launch an entire Ashland Green University and a learning and development platform. So we had to hire those people. So, our construction management, they require a lot of software, Procore. I mean, it only breaks even at around 8,000 units. So we lose money on it every year. But in terms of what we're able to do from the operations standpoint, we make it up for our returns to the investors.
Yeah, I was in a mastermind and they were asking me, why don't you vertically integrate and have property management in-house? Investors ask me all that all the time as well. And yeah, what do we pay property management companies?
3% of gross collections.
Yeah, I mean, that's really worth giving away 3% and not have to deal with that headache. It's not like you said, it's not a huge moneymaker, but the way you have it done, it's a moneymaker for the investors, but it's not like a moneymaker for us.
Yeah, and absolutely. And I would honestly, we've been approached to do it for other people, and I would never do this for any other operator because it's a lot. But it's for the investors, I'll do it. You know what I mean?
Yeah.
And that's how we got started during COVID. It was for the investors. back was against the wall. Third party wasn't performing. We had to take over. It was our job. They gave us money. They trusted us. We gave them our word, right?
Mhm. Love it. Yeah. Well, I'm excited to partner with Ashland Green on this.
Yes, likewise. This has been great.
Amy, as always, I love partnering with you on all the deals we've done together.
So many. I
Yep.
love it. And this is the first or the second and third of many with Ashland Green as well. It's been a great relationship and we're excited to continue to grow.
Yeah.
Cowboy hats on Monday. I'm marking
Cowboy
my
hats on Monday. Everyone who's still here, over 100 folks, feel free to wear your cowboy hats on Monday as well. We won't be able to see you, but you can put hat in the chat and we'll be like,
Icons, perfect. Look in the chat. They've even got the icon. It's
Ooh,
perfect.
look at
Yeah.
Oh, nice. Very nice.
oh yeah.
Came ready. You came ready today, Amy. You're fast.
Perfect. All right, everyone. Well, I'm going to say thank you so much again to everyone on the screen, and thank you everyone in the audience for participating and making this really fun for us. It's fun. It's fun to do this, and it's fun to make money. It's fun to have fun making money. So
Yeah. Thanks, Sarah. Thanks, Shakti.
Yeah. Thank you guys so much.
Thanks, everyone.
All right. Thanks. Bye, everyone.
Talk soon.